Welcome to Thoughts on the Market. I am Vishy Tirupattur, Morgan Stanley's Chief Fixed Income Strategist. Today, I'll talk about the impact of last week's 90-day pause in the reciprocal tariffs between the U.S. and China and the impact on the economy and markets. It's Monday, May 19th at 11 a.m. in New York. The market response to last Monday's announcement has been resoundingly positive. The S&P 500 was up 4.5% in the first 4 days since the announcement, and the year-to-date returns are back in the black after Liberation Day drove steep declines in April. Credit markets have also rallied notably, with investment-grade spreads tightening by over 10 basis points and high-yield spreads by over 50 basis points. And the Treasury market took out 50 basis points of rate cuts in 2025, leaving market-implied rate cuts by the end of 2026 at around 100 basis points. While these moves across markets are significant, it is really important to put them into perspective and tease out what this detente in trade tensions implies, and more importantly, what it does not imply. On the positive side, we think that the de-escalation reduces the risk of a sudden stop in trade volumes and a sharp rise in unemployment rate. While this is clearly just a truce, and we don't know exactly where the tariffs between the two largest economies in the world will end up, it seems reasonable to infer that tariffs in the vicinity of 125% or 145% are substantially less likely now. Overall, the probability of a U.S. recession, therefore, has fallen on the margin. To be clear, a recession during 2025 was never really our base case. But the de-escalation shifts risks in the direction of a little more growth, a little less inflation, and keeps unemployment rate at near current levels. If the world before Liberation Day was bimodal and close to a coin toss, it is still bimodal, but skewed towards an expansion, not contraction. Since we were in the expansion mode to begin with, this detente gives us greater comfort in our baseline outlook and strengthens our conviction that the Fed will remain on hold for the rest of the year. The positive vibes from Geneva notwithstanding, we would stress that it is far from clear that the 90-day pause is an uncertainty clearing event. Trade tensions are likely to remain elevated. The administration is still investigating tariffs on pharmaceuticals, semiconductors, copper, and other products. It is also unclear if the template of negotiations between the US and China can work for other regions, especially Europe. Even if US tariffs on imports from China and the rest of the world end up roughly around the current levels, they would still be about 4 times higher than the levels at the start of the year. This means inflation should continue to move higher into year-end, with a surge that peaks in the third quarter. While the impulse to inflation from tariffs is likely to be smaller, it still is coming. Likewise, higher tariffs will dampen growth even though recession will continue to be avoided. For risk markets, we think that the detente has reduced the risk of substantial drawdowns. While policy uncertainty about the ultimate level of tariff remains, a return to last month's mind-boggling volatility driven by trade policy is probably behind us. So it is unlikely that we will see markets revisiting the lows of April in the near term. For credit markets, a lower likelihood of recession is indeed welcome news, especially considering the current strong credit fundamentals. With the market taking out a couple of rate cuts, the all-in yields for credit remain in the range to sustain the demand for yield buyers such as insurance companies. Thanks for listening. If you enjoy the show, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.